Hi students, welcome to this video session. My name is Samuel Chukwu Emeka, aka Samdom for Peace. In this video session, we shall discuss investments for retirement. Let's go to my website. I type in my name. And the first one is my website, samuelchukwuemeka.com. Click on my picture to enter the site. Then click on mathematics. And I posted this note under Exploring Math. Exploring Math. And click on Notes. Click on Investments for Retirement. Investments for Retirement, Part 1. It is also under Finite Math as well, because this is a mathematics of finance, which we are doing at the moment. So let's look at this slide. I posted this on OneDrive, which is good. I found out that OneDrive is good. OneDrive from Microsoft. So my ROA, the President Obama, he mentioned this in one of his State of the Union address. I don't know whether you know about it, but it is for low-income and moderate-income Americans to begin saving for retirement. So this is my ROA, my retirement account, and these are some of the things that they said about it. You can read it. The websites having this information is on the last slide, so I will show you the websites that contain the information. Okay, let's get started. Why do we need to invest? Why do we need to invest? Raise your hand if you still want to be working very hard by at what age would you want to retire? And when I mean retire, it does not mean, okay, you stop working entirely. No. You know, once you're alive, you need to do some work, you know. But I'm talking of working so hard, like getting up early in the morning, going to work, and then getting off late in the evening. At what age would you want to retire? What do you think the average age of retirement should be? You know, this is something, it differs by countries. If you look it up online, you will see the different ages of retirement. Some countries, it differs between men and women, you know. Some countries raise the age of retirement for men. So these are just some questions, you know, thoughtful questions that we discuss in class as we begin this topic. Which country has the highest retirement age for men, for women, and what are those ages? So find that out for yourself. Which country has the least retirement age for men, women? What are the ages? Are you really planning for retirement? Is it something that you have ever thought about, or you want to just use your money and you're not setting aside some savings? Your company might be offering 401k and you don't want to enroll in it. Is it not your worry now, or do you ever think about, okay, I need to save some money so that, you know, by the time I retire, the money will be enough for me to enjoy my retirement? So those are just thoughtful questions. And if you are an American citizen, you know, you don't want to rely on Social Security benefits alone. Congress is messing up with it, you know, and you don't know what will happen. It's something that, you know, you should have your voice, have a say that, hey, don't touch my Social Security. But they are messing up with it, you know. It's one of the topics for debates, among political debate. So what if there's something happens and, you know, they decide to cut the Social Security retirement benefits? What are you going to do? Do you have a backup? Okay, so you have to make your voices heard about it if you're a U.S. citizen. And at the end of this presentation, I would want my students to list and define the basic types of investments in the United States, differentiate between traditional IRAs and Roth IRAs. IRA means individual retirement account. Yeah, so differentiate between traditional IRAs and Roth IRAs. They would be able to read and interpret stock tables. You should be able to look at a stock, read the stock table and interpret it. Also, solve calculations involving 401ks and the IRAs, and then calculate the future value of an ordinary annuity. We shall talk about annuity, and we shall solve some problems on annuity. Okay. Now, investment. What is investment? We define investment. Of course, investment could be seen in several dimensions. You could define it in several ways. But for this presentation, we are talking of cash investment. You want to invest your money. You want to set aside some money and invest it in a business, in a savings, in a stock, in a bond, you know, in mutual funds. You want to invest your money and yield, for that money to yield return, to yield a good dividend, a good return, okay, to yield profitable returns. Nobody wants to make an investment and lose, right? If you wanna, if you want to make an investment and it will result in a loss, raise your hand. I don't see any hands up. So there are two main things when you want to invest your money. You should have two things in mind: risk and return. Okay, some investments have low risk and high returns. Some have high risk and low or no returns. So it all depends. But there is the risk because of uncertainty. We are uncertain about what will happen. Okay, just like the 2008 financial crisis that really messed a lot of people up. So there is always risk, especially because with humans we are greedy in nature, and because we are greedy in nature, and we have the insatiable lust for money. So you tend to find some people who you think you might trust with your investments, but they go because they are greedy, or they take risk, unnecessary risk, or they just mismanage the money, which some of them do, you know, and then we bail them out, unfortunately. So there is always two things with cash investments. You have the risk and you have the return. Some investments will carry no risk. If you deposit your money in most banks in the United States, the federal government, the United States federal government insures that money up to $250,000. So in case there is problem with the bank or financial institution, you are ensured that you will get your money back. What we call return on investment. It should be a profit, not a loss. You don't want to have a loss, especially when you invest your hard-earned money. You don't want to have a loss. So there is an interest rate that guarantees a % increase, of course. I have not seen any bank or financial institution with a negative interest rate. So all the interest rates are positive interest rates, which guarantees a return on your investment. Okay. Now, as you go into work for any company, there are two things you should bear in mind. There are two goals of every business. One is to maximize profits, and the second one is to minimize cost. So wherever you're working, you want to really work very well for the company to make profits. You want your company to make the maximum profit they can make. You want to put in your effort for the company, and you also want to minimize the cost for that company. In minimizing the cost, you are even helping out the company, including potential layoffs. You want to save electricity. You want to, if you're not using electricity, you want to save it, and some other things you want to do to make profit for the company, which when you now put in your effort and make profit for the company, of course, the company is now supposed to pay you more, raise your salary, because you're putting in your effort for the company to make profit. So these are the two goals of every business: to maximize profit and to minimize cost. Some investments will result in a profit and some will not. Mismanagement of investments, greediness, insatiable lust for money. Okay, these are part of the reasons why some investments result in a loss. Sometimes the higher the risk, the higher the return, but it's not a rule. When you have a low risk, like when you invest in bonds, investing in bonds, they are low risk investments, but it's usually a low return. So and some investments that are high risk are usually high returns, but it's not a rule. It's not. All right, let's look at the basic types of investments in the United States. Okay, this is a Series 1 bond. That's bond. We have stocks, we have bonds, we have mutual funds, we have a retirement savings accounts. Now, the retirement savings accounts includes regular savings accounts. It also includes other investment accounts like your money market account, certificate of deposits, and the rest of them. Several banks have, if you go to your bank, you ask them about investment accounts, and they list it. They have several investment accounts. We also have interest-bearing checking accounts you can use as investment too. Some banks offer interest on checking. Some do. Especially credit unions. I think credit unions are better than banks, if you ask me. Well, let me not go into that issue, but if you ask me, I think so, because some of them I've looked into, I've researched, they offer interest on checking accounts, which some banks I know do not, and their interest rates, even for those banks that offer, I know about only one, the credit unions I know even offer more interest rates. So the only thing about credit union and these banks is, for instance, if I go to Chicago or maybe to Florida, the credit union I bank with here might not be there, of course. It's likely not going to be there, but the bank will be there. If in Chicago, you probably will see Wells Fargo, probably will see Regions, but those banks don't offer interest anyway, But the credit unions, some of them do, which you might need to look into on the checking accounts, you might need to look into them. Now, they didn't pay me to talk about them, okay? I'm just being honest. From my research, my reading, my experience, that is why I'm talking about this presentation. Nobody paid me to advertise or something, no. But from my experience so far and my research and my studies. We also have the traditional IRA, individual retirement account, and we have the Roth IRA, okay, as part of retirement savings accounts. Then also we have employer-sponsored retirement plans, and these include the 401k plan and the 403b plan. That's section 401k of the internal revenue service, IRS service code, internal revenue service code, and the section 403b. We shall talk about those later as we move on in this presentation. So all these are under retirement savings accounts. And then my ROA. I didn't put my ROA. You can put my ROA. What is stock? And why do we have stock? Now, at some point, companies might want to recruit more personnel or more talent. They might want to diversify. They might want to open up businesses in several other locations. They might want to develop and test new products. Okay, they might want to offer new services. So this requires money. They need money to do this, and they have two ways to do that, to get that money. They can either borrow money from the bank or financial institution, or they can raise money from investors by selling part of the company. They can sell part of the company, which means some ownership of the company, so that they, in what we call in the form of shares of stocks, so that those shareholders, people who buy those shares of stocks, will own part of the company. So more than likely they will prefer the second option, and that is where we talk about stock. A stock is an ownership of a corporation, which is indicated by shares, and it is held by an individual or a group of individuals. Stocks of public corporations, we usually have a unique 1, 2, 3, or 4 letter, what we call ticker symbols. Okay, stocks of public corporations have a ticker symbols to represent them, to identify them. And for instance, when you go to Yahoo Finance, the website is also in the last slide of this presentation. If you type in any company, any public company, you will see the name and the ticker symbol for that company. F is Ford Motor Company, KO is Coca-Cola, and the rest of them. Now, what is a corporation? Because we mentioned ownership of a corporation. Corporation are people, my friend. A corporation is a legal entity created and authorized to operate under the laws of a state for the purpose of conducting business. Now, what are shares? Shares are, when you buy stock, of course, we call them shares of stocks. Shares are certificates. It could be certificates given to you to indicate ownership, or it could be electronic. Okay, when you go to some websites like computershare.com, there are several websites you can go and you buy stocks there. You can also buy it from individuals, from stockbrokers, and the rest of them. Now, but when you buy the shares of stock, it indicates that you own some percent in the company. You have a stake in the company. Of course, a shareholder is the person that owns shares of stock in a company or a corporation. Trading, what do we call trading? When you talk about trading in the stock exchange market, trading means buying and selling of shares of stock. Buying and selling of shares of stock is what we call trading. Shares of stock need both a buyer and a seller to be traded. Now, and the stock exchange is a formal marketplace for buying and selling securities. When we talk of securities, it includes stocks, bonds, and the rest of them. It does not include only stocks. Yeah. There are several financial terms that that is involved in this presentation. We will not have time to go over all these. This is just for you to have the basic knowledge of investments and the terms involved, and then be able to do some calculations involved. Some stock exchanges include the New York Stock Exchange, NYSE, the International Securities Exchange, and the rest of them. We have several of them. Securities are investment instruments that signifies an ownership position in a corporation. Securities can include stock, like I mentioned earlier. It can also include a bond, whereby you don't own the company, you don't have any ownership, any percentage of ownership of the corporation, but you have some debts of the corporation. You own bonds, that have some maturity year or rights to ownership. So these are all what we refer as securities. The price of a corporation's share of stock usually indicates how well the company is performing. Of course, if the company does well, then the stock will rise, and if the company does not do well, it falls. Stock price goes down. Stock, we're still continuing in stock. Investing in stocks may lead to what we call capital gain or capital loss. When you invest in stocks, it may lead to capital gain or capital loss. Capital gain is whereby when you buy if you study the financial market, sometimes the shares of stock price will go down, and you rush immediately and you buy it, and the company starts performing well, and then stock price after some periods, months, weeks, months, years, maybe, stock price goes up and you sell it. So you make what we call capital gain. Then if you sell it below what you paid for it, that is capital loss. Investing in stocks may also lead to dividends. When the company does well, some company pay dividends. In some periods after some periods they pay dividends to the shareholders. Or if they do very well, they could also give out more shares of stocks, to the shareholders as well. So capital gain is the profit resulting from the sale of stocks. When you sell your stock for more money than what you paid for them, you make a gain. We call that capital gain. And when you lose money, when you sell for less than what you paid for it, it is capital loss. Of course, a good reason why there are capital losses is when a company files for bankruptcy. Dividend is a portion of the profit or all of the corporation's profits that are paid to the shareholders of the corporation. When the corporation makes money, makes good profit, they pay dividends, or they can even give more shares of stocks to the shareholders. Now let's look at an example on how many percent of a company a shareholder actually owns. So let's use Facebook Incorporated. Let's use Facebook for example. Assuming Facebook issued a total of 2 million shares, and somebody called Mark bought 600,000 of these shares, right? What is the percent ownership? How much percent ownership does Mark have in the corporation? So, of course, this is percent. You have to first of all do 600,000 divided by 2 million. That gives you 0.3. And we of course, we indicate this by percent. So 0.3 times 100, which means Mark owns 30% of the company. Now, let's look at stock tables. Stock tables are used to monitor the performance of the stock of a corporation. They also serve as a valuable tool in making investment decisions on which stocks to buy or not. When you look at stock tables of companies, it kind of tells you, okay, how well this company is performing. If the company is performing well, should I buy some shares of stock of this company, or should I wait? Now let us study and interpret the stock table below. So a stock table looks like this. We shall also look at Yahoo Finance. If you look at Yahoo Finance, you see another way a stock table can look like. Now let us explain what each of these terms mean. When we talk of 52-week high, if you look at the table, there is no dollar sign. There is no dollar sign, but it means $90.97. This means that the highest price at which Walmart, the ticker symbol is WMT. If you go to Yahoo Finance and you type in Walmart, you will see WMT. So 52-week high means the highest price for a share of Walmart stock for the past 52 weeks. Somebody was able to pay $90.97 for a share of Walmart stock during the past 52 weeks. And then 52-week low means the lowest price that a share of Walmart stock sold. For the past 52 weeks, the lowest price that the share of Walmart stock sold during the past 52 weeks. Now, when you come to Walmart, when you go to Walmart, of course, a lot of people shop at Walmart. Who does not shop at Walmart? Raise your hand. Unless Walmart is not in your area. If Walmart is in your area, there is a high probability that you have gone to Walmart. High probability. Now, when you go to Walmart, and of course, if you work in Walmart, I think they probably offer a 401k. Okay, find out about it. And also ask whether you can be a shareholder at Walmart. You, as an employee of Walmart, you probably will get a lower price for when you buy stocks. When you buy Walmart stocks, as an employee, you might get it as a reduced price. So just find out about it. When you go when you come into Walmart and you go to the back where you have the restroom, you usually see, okay, today's stock is this. Tomorrow depends on you. So that is an example of that. I don't know whether you have noticed it or not. They usually paste it at the back, at the back when you go to the restroom at the back. So the stock is Walmart, of course. The company stock is Walmart, and the ticker symbol is WMT. Now the dividend, this is a dividend per share. Okay, dividend per share. If we look at it, DIV is $1.92. So that tells you that Walmart paid $1.92 per share to its shareholders during the past year. Okay, it paid the shareholders $1.92 per share. So if you owned like 100 shares of Walmart, that means they paid you how much? $1.92 times 100, which is $192. Okay, this is just money you earn. Now imagine if you calculate it, you compare it to maybe a savings account or an IRA account, and then you can kind of compare, do your calculations in a year whether you might get up to that as dividend. If you check the price of 100 shares of Walmart stock, and then see whether you can if there's any bank that even offers an interest rate, if you invest that money, if you invest that capital in any bank, is it going to give you $192 in a year? $192 in a year. If you invest the amount of 100 shares of Walmart stock in any bank that offers any interest rate, is it going to give you at least $192 in a year? I mean, of course, savings account is not going to give, I mean, maybe some banks, depending on their interest rates. You just have to find out. It's all about finding out. And then the yield percent, this is what we call the percent yield. You may wish to copy this table so that you can go along with me. Yield percent means the percent yield based on the dividends alone. Okay, in that case it was 2.2% based on the dividends alone. The sales volume in hundreds. In this case, you have sales volume in hundreds. So this means how many shares of Walmart stock? How many shares of Walmart stock were sold yesterday? That is what it means. How many shares of Walmart stock were traded? Traded. Traded means buying and selling. Okay. How many shares of Walmart stock were traded yesterday? So the sales volume in hundreds, it means you now multiply that 46581 times 100, and that means you have a 4,658,100 shares were traded yesterday. The high means the highest price at which a share of Walmart stock was traded yesterday. Highest price at which it was traded yesterday. The low means the lowest price at which it was traded yesterday. Close means how much at closing yesterday. How much did a share of Walmart stock? Okay, how much was it traded? A share of Walmart stock. How much was it traded at closing? So that was $88.51. Net change means net change in this case is plus 0.12 dollars. Okay, 12 cents. That is 12 cents. Now, what does this mean? This means you compare the closing price of a share of Walmart stock 2 days ago, and then compare the closing price of a share of Walmart stock yesterday, and find out whether it went up or went down, or whether there was no change. So in this case, the net change being 12 cents plus 12 cents means that the closing price of a share of Walmart stock went up. You know, when you compare it 2 days ago to yesterday, it went up. It went up by 12 cents. That's what it means. PE ratio, price to earnings ratio, is 18. Now, what does this mean? PE ratio, we have the formula for PE ratio. It is yesterday's closing price per share divided by annual earnings per share. So you find annual earnings per share first by doing that, by using that formula. Of course, this is algebra. Okay, when you multiply both sides by annual earnings per share, or you can say cross multiply, then you now divide both sides by PE ratio. So you have that annual earnings per share is yesterday's closing price per share divided by the PE ratio. So when you do the calculation, you have that. I can pull up the calculator to show you. Calculator to show you, and of course, when you pull up your calculator, it's usually in a standard. So it's usually like this. So just click view, change it to scientific. So when you now do this, 88.51 divided by 18, you have a $4.92 is the annual earnings per share. So what does this tell you? What actually does this tell you? It tells you that yesterday's closing price per share is 18 times greater than the annual earnings per share. Yeah, just like when you cross multiply from here, yesterday's closing price per share is 18 times PE ratio times annual earnings per share. So 18 times annual earnings per share, which is $4.92. All right, let's come to bonds. Now, why do we issue bonds? Why do we even have bonds? The U.S. Treasury, they might need money to balance the, pay up some federal deficits. The state of California might need money to invest in their schools, repair their infrastructure, build housing, parks, public facilities, develop and maintain public facilities. Mobile County in Alabama might need money to do a technology initiative for their schools. The City of Truth and Consequences. I just like that name, honestly. I like that name. I mean, truth or consequences. That should be truth or consequences. Yeah, I like that name. There's a city with that name in New Mexico. So they might need money for a geothermal development project. Elora hospitals might need money to fund research for Ebola vaccine or HIV vaccine and the rest of them. So just like that was 2 days ago or 3 days ago, I was reading that Apple needs money. Apple needs money, so they are issuing bonds. They are issuing some billions of dollars in bonds to buy back some shares and pay dividends to the investors, among others. So when company or municipality, government needs money, if they don't want to sell shares, like owning part of the company, they issue bonds. Bonds are like a promissory note. Okay, I need money, okay? This company needs money, the federal government needs money. Let's give you this bond, buy it. So I get the money, and after some years, maturity years, I'll pay you the money and the interest. Okay? A bond is a promissory note. It must be paid. Okay? It's an evidence that you are buying up their debts. When you buy the federal government bond, you're buying up some of the debts of the federal government. You buy California bond, you're buying up the debt. So the issuing corporation promises to pay the bondholder the face value of the bond on the maturity date, as well as the interest over a given period of time. Now, what is face value? Face value of the bond is the amount the issuer of the bond agrees to pay at the maturity date. In that bond that showed Martin Luther King image, you saw that the face value was $100. Yeah. So it is also known as the maturity value of the par value, or the par value. It is the principal amount of the bond. Okay, maturity value or the par value. Maturity date is the date that the bond finishes and it's paid off. Bondholder is the owner of the bond, of course, just like shareholder is the owner of the share. Bondholder is the creditor of the corporation. Now, what is the difference between shareholders? What's the difference? What's the major difference between a shareholder and a bondholder? A shareholder buys shares of stock, meaning that he or she owns percent of the company or the corporation. A bondholder does not own part of the corporation. Bonds are less risky because if anything happens, if a corporation goes bankrupt, okay, the first people to be settled are the bondholders. They bought debts of the company. Okay, the company they owe them money. They owe them money. Okay, so they are the ones to be settled first before the shareholders. So because of this, bonds are less risky. Investing in bonds is less risky than investing in stocks, although the return is usually lower. Mutual fund. Okay, what if you don't want to put all your money, all your eggs in one basket? Okay, let's say you want to have some shares, you want to have some bonds, you want to have some other securities. Okay, you don't want to put all your eggs in one basket. Well, you could think about mutual fund. Now, mutual fund is something else. Okay, if you have a good manager, okay. If you have a bad manager, that is where the problem lies. You make a risky bad investment, that is where the problem lies. But guess what now? It is with mutual funds, you know, it's because what you do is this: you give money to a fund manager. Okay, the fund manager collects your money, collects other people's money, collects Mr. A's money, Mr. B's money, Mr. C's money, collects all these funds, and now invests it in buying shares, in buying bonds, in buying other securities as well. So you own, that means in essence you own several companies as well, because your money is also invested in buying shares of stocks of several companies. So the advantage about it is that if a company does not do well, then the other company might do well. You understand? Because it's diversified. Okay? You're not just putting your eggs in one basket. Your money is being used in several other investments, in several other companies, not just in one company. So if you have a good fund manager, that is where you enjoy mutual funds, buying and selling bonds and shares of stocks and other securities to yield the maximum possible returns. So you own a small part of many companies with a mutual fund. It offers that advantage of diversification and professional management. The total investments that a person has in a mutual fund is what we call financial portfolio. A mixture of low risk and high risk investments is called a diversified portfolio. Now let's look at the retirement savings account. It is a great advice. Start saving money. As soon as you get a job, begin to save money. Do not wait. We have listed this before, but we can look at it again. What are the differences between the traditional IRA and the Roth IRA? Traditional IRA, you can deposit up to $5,500 per year, up under 50 years of age. If you are under 50 years of age. Now, if you're 50 or older, you can deposit up to $6,500 a year. Why is that? Why? Well, you should answer it. Of course, 50 years or older is almost closer to retirement than when you're under 50. Taxes are not paid when you deposit the money. So you don't pay taxes on the front end. But guess what? You pay taxes on the back end. When you withdraw the money, you pay taxes. That is the traditional IRA. So when you deposit money, you don't pay tax. But when you withdraw, you pay tax. And then you cannot withdraw. You cannot withdraw unless you are 59 and a half years old. So you start withdrawing. If you want to withdraw, you may begin withdrawing when you are 59 and a half years old. Roth IRA is the same, except that taxes are paid on the front end, but taxes are not paid on the back end. When you deposit money in a Roth IRA, you pay taxes. But when you now withdraw the money, including the money, the principal, and the interest, when you withdraw it, you don't pay taxes. So which one do you think is better? Which one do you think is better? Which one? I mean, if you ask me, I'll go with the Roth IRA. Because look, when you are withdrawing the money, including the interest, you're not taxed. Can you imagine that? I mean, that's nice. And who knows what might be the rate of inflation, or well, what might be the interest rate, or whether there's inflation then or deflation then. I mean, you don't you know, if you look at it, things keep on rising. Prices of things keep on rising. So it's good when you now want to retire and you now withdraw this money. You don't, you withdraw it. You're not taxed on it. You're not taxed on the principal. You're not taxed on the interest. So I'll go with the Roth IRA. That's me. What a 401k plan? 401k plan was formed as a law under Section 401 of the Internal Revenue Tax Code. It is offered by for-profit companies. When you are working for any company and they ask them whether they offer any retirement savings account. If they offer 401, think about it, okay? Because the company usually matches it. They match it, okay? It's set up by the employer so that you can contribute money. Money comes out from your paycheck, but they match a percentage of the amount you contribute. So think about it, okay? I know you might say, oh, no, I don't want any extra money coming out from my paycheck, but think about it. Because the contributions you even make are not taxed, okay? They're not taxed. And then the employer matches it. So it's like giving you extra free money on top of what you contribute. The withdrawals are taxed, however, okay? Currently, employees under 50 years can contribute up to 15% of their salary, but no more than $11,000 annually. And then employees over 50 can contribute that, but no more than $12,000 annually. Now, 403B is similar to, the tax plan is similar to 401k, but it's formed under Section 403B of the Internal Revenue Tax Code. And also it is offered by tax-exempt organizations like schools, institutions, universities, hospitals. It is similar to the 401k plan. The contributions are not taxed, but the withdrawals are taxed. Now, other investment accounts include your regular savings account, your money market deposit account, interest-bearing checking accounts, I've talked about it, CDs, certificates of deposit, and then pension plan, and so on and so forth. Now, what is an annuity? An annuity is defined as a sequence of equal periodic payments. It could be payments you contribute every month. It could be monthly payments. It could be yearly payments from your paycheck. It could be bi-weekly. It could be weekly. It could be every 6 months, semi-annually. If the payments are made at the end of each period, we call it an ordinary annuity. If the payments are made at the beginning of each period, we call it an annuity due. Annuity due. Now, we are interested in, for this presentation, we are interested in ordinary annuity. That is what we are interested in. Okay, so you are making these deposits to a financial institution, or you are on 401k plan. Money is coming out from your paycheck every month, and your employer is matching it. When you now want to retire, okay, or at the end of a certain period of time, all that deposits you've made, including the interest, is what we call the future value of an annuity. Sum of all the payments, all the deposits, and all the earned interest, okay, is what we call the future value of an annuity. Now, that is the formula. So, why are we studying annuity? Why? Because it's seen in college savings accounts. Some states probably have college savings accounts whereby, you have your child, your son or your daughter, and you want, okay, by 18 years of age, you want enough money for your daughter or your son to go to college. So you begin to make payments probably every month or every year. That is similar to an annuity. So college savings accounts, IRAs, 401k, 403b, and any other investments that require periodic payments, deposits, is why we are studying annuity, future value of an annuity. So this is the formula here, okay? Is it a big formula? Don't worry, it's not. This, I know this is the first formula which we shall use for this presentation. You also have another formula, second formula here. You can take it down. And these are the definitions here of what those variables mean. Question time. Look at the stock table. What are the high and lows for the past 52 weeks? This is Coca-Cola. So if you look at it, you will see the responses here. High is $45. Low is $36.89. If you own 700 shares of Coca-Cola stock last year, what dividend did you receive? So you look at the dividend here. This means the dividend is $1.22 per share. Per share. So if you own one share, you had $1.22. So, but you owned 700 shares. So you have $854. You multiply that. Okay. What is the annual return for dividends alone? That's the yield. You look at it. How many shares were traded yesterday? That's the same one. The same way we do it. You multiply this by 100 to find out. What were the high and low prices for Coca-Cola shares yesterday? It is in the stock table. Then what was the price at which the shares last traded? That is closing price, $41.17. What does the value in the net change column mean? So let's look at the net change column in this. You see, it's 3 dots. When you see 3 dots in the net change column, that means that there was no change. Okay? That means that there was no change at all. There was no change. What was the price at which it last traded? 2 days ago. Now, in this case, because there was no change, remember, net change means we are looking at the closing price 2 days ago compared to closing price yesterday. So there was no change. So the price at which it traded 2 days ago is the same price at which it traded yesterday. So that is why it is still $41.17, because the net change was 0. And then compute the annual earnings per share. You now use the formula and you get $1.79. Okay, question 2. Luke decided to begin saving for retirement at the age of 32. He decided to deposit $70 at the end of each month in an IRA that pays 5% compounded monthly. A. If he retires at 65 years of age, how much will he have in the IRA account? B. Find the interest. Round your answers to the nearest dollar. So, if we look at this, okay, this is an annuity because at the age of 32, he started to deposit $70 every month at the end of every month into that account. The account pays 5% compounded monthly. Okay, before you continue with this video, you looked at the prerequisite. Please, you need to view the videos under Mathematics of Finance. It is very important that you do that. So here the the periodic payment is $70. The interest rate is 5%, which you convert to 0.05. And then it's compounded monthly, so M is 12. The time he started depositing the money when he was 32. And then he retires at 65. The time is 65 minus 32, which is 33 years. All right, so I'm going to show you this, because students usually have issues of trying to solve this step by step. I did this step by step so that you don't make mistake. Okay, so if you want to do this, I'm gonna do this with this calculator here, and then we go to the next slide. So you have to just substitute these values. M is 12, the payment is 70, arrow, the interest rate is 0.05, 5%, which is 0.05. The number of compounding periods per year, is compounded monthly, so M is 12, and the time, T, is 33, because he started depositing the money when he was 32, and now he retired at 65, so it's for 33 years. So the first thing you do first, let's do M times T. So 12 times 33. That gives us 396. You see that? 396. So the next thing we do is this. We can store this in memory, M plus. Let's store it in memory, M plus. Then we do 0.05 divided by 12 equal to, remember we have to do parentheses. We are doing PEMDAS. So inside the parentheses you have the division. So you do 0.05 divided by 12 equal to, each one you do equal to. It gives you this. Then you do plus 1 equal to, gives you that. Then x raised to power y, this is the exponent, x raised to power y. Okay, raised to power, recall the memory. All right, recall memory, 396 equal to, okay, you see that. Then you now do minus 1 equal to, then you do divided by 0.05 equal to, you see, I don't round up until the final answer. You don't round up until the final answer. Now, times 70 equal to times 12 equal to. So you have 7377.90. Okay, let's see whether that was what we got. 7377.90. You see that? Yeah, but I did this step by step. So if you look at this slide, you see I did it step by step. Okay, in this case I multiplied 12 times 70 to give me 840, and then I multiplied 840 times this, then divided by 0.05. It doesn't matter whichever way you do it. Okay, just do it step by step and use PEMDAS. You have to we multiply the exponent, then inside the parentheses we did the division first. Now it doesn't matter if we had started with the parentheses. Okay, we'll still have to multiply this anyway to give us 396. So do it step by step and you'll get it right. When you do it, you get a 70377, 70,377.90 cents, and we just approximate it to 70,378 cents. So this is the amount he will have in his account. Approximately this 70,378 cents when he retires at 65 years of age. Now let's find the interest. What will be the interest? Remember, he was depositing, okay? He was making periodic payments of $70 every month for 33 years. So 70 per month times 12 months in a year, okay? Then times 33 years. So if you want to find out the interest that he earned on those payments, that would be the future value of the annuity. This is the money, okay, minus, you now have, he was making payments $70 every month, and he made this payment for 33 years, but you have 12 months in a year. Okay, so every year he was paying $840 every year, and then he made this payment for 33 years. So that gave you, he made a total of $27,720 for 33 years. So look at his interest here. That's not bad. $42,658. That's not bad, you know. And he just started when he was 32. Just paying $70 a month. I mean, you know, if you check your expenses every month, you see, oh, I would have used this $70 wisely. You know, I would have just made a payment on this IRA account. So just think about it, okay? Let's do question 3. Between the ages of 22 and 28, Rita contributed $7,000 per year. Now, question 2 was, look, contributing monthly. Question 3, Rita contributing yearly per year to a 401k. Then her employer matched it 50%. So her employer matched her contribution per year. Her employer matched it 50%, which is $3,500 per year on her behalf. The interest rate is 8.6% compounded annually. What is the value of the 401k at the end of the 6 years? Okay, she started work. She worked, you know, for 6 years for the company. Round your answers to the nearest dollar and use the whole dollar amount for subsequent calculations. B, after 6 years, okay, let's do A first. So this is an annuity, okay? The payment is what? In this case, the payment will be $7,000 plus $3,500, $3,500. So which gives $10,500. That's the payment. Then the interest is 8.6%, which you convert to decimal, 0.086. The is compounded what? Annually. So M will be one time per year. Okay, and then T will be 6 years. Time is 6 years. So when you do that, okay, this is what you get. You do it step by step, and you get the future value to be approximately $78,202. So try it, you know, and that is what you get. Then B, after 6 years of working for this firm, she moved on to a new job. However, she kept her accumulated retirement funds in the 401k. How much money will she have in the plan when she reaches age 65? So when she left the company after 6 years, she didn't go to withdraw her 401k. Okay, if she withdraw it now with 401k, if you withdraw it before the time you're supposed to withdraw it, then you pay penalty. Okay, you pay taxes, and then you still pay penalty for withdrawing it early. So she just left it until she retired at 65. So she doesn't want to pay penalty, and she will still pay taxes, but she will not pay penalty for withdrawing it early. Okay, but so when she left the company, the money was still there, okay, yielding interest. So how would you calculate that interest? How would you do that? How would you calculate that interest? You now use the compound interest formula, okay? Because it's still compounded annually. She's no longer making those monthly, yearly payments. She's no longer paying $7,000 per year from her paycheck, and her company is no longer contributing $3,500 per year on her behalf. So it's no longer an annuity. Annuity involves periodic payments. But now that money, okay, they want us to use the rounded value for subsequent calculations. So this money will still be compounded annually at that interest rate. So when you do that, in this case, the payment is $78,202. Okay, we do, of course, 1 times 37. We want to do it first, which is 37. Then we do 0.086 divided by 1, that gives us 0.086. Then plus 1, we have to use compound interest formula to do this. So 1.086 raised to power 37 equal to, then times 78202. So this is their money, and then how did we get 37, folks? How did we get 37? Because she left when she was 28. She stopped depositing money, but she left that money there until she retired at 65. So the time is 65 minus 28, which gives us 37 years. So after 37 years, she has $1,655,470. Do you see that? $1,655,470 approximately. I mean, even if she pays taxes, that's not a bad money for retirement. And this is just a company she worked for 6 years. Okay, but she was enrolled in 401k. Okay, so think about it. If you're working for a company, ask them about the retirement accounts. If they have 401k, ask them how many percent they match, and consider enrolling in it. It does not hurt. Hopefully it will not hurt. Hopefully the managers at street, the managers at street will be able to manage it well. Okay. You know what I'm talking about, right? Okay. The next question was how much did she contribute to the 401k plan? Well, 7,000 times how many years? 6 years. So she contributed 42,000, and her employer matched 50%. So 50% of 42,000 is 21,000. You see, I'm doing it even without using a calculator, you see. But employer, you can do 3,500 times 6. That should give you 21,000. And then the difference, what is the difference between the amount of money she would have accumulated in the 401k and the amount she contributed to the plan? What is the interest that she made? Rita, right? That's her name. Okay, what is the interest she made? Amount she contributed to the, this amount yielding up to this. Then minus 42,000 that she contributed. So this is like the interest, like here. But this is now from 22 years to 65 years in all. This is the amount. And we didn't even talk about, okay, when she left the company after she was 28, okay, where else did she work? No, this is just for the 6 years she worked for the company, and then she left it there to mature until she was 65 before she withdrew it. So just, this is food for thought, okay? Question 4, between ages of 25 and 40, Lucy contributed $5,000 per year to a 401k, and her employer matched it dollar for dollar. So, what is the payment? This is annuity, but what would now be the payment? The payment will be $10,000. Okay, it's gonna be $10,000. So, interest rate is 0.075 because that is 7.5%. End of 15 years, between 25 and 40. So, let me show you once more how you can use the calculator to do this. Let me remove MC, change memory, remove the memory. Okay, clear entries, CE. Now, we want 1 times 15 is 15. So we do the parentheses 0.075 divided by 1, the division in the parentheses, then plus 1 equal to, then raised to power 15 equal to, then minus 1 equal to. And if you want, you can divide it by this, or if you want, you can multiply it by 10,000 before you divide. It doesn't matter. So 10,000. Always put equal to, then divided by 0.075. Okay, so $261,184 approximately. $261,184 approximately. And then you do it just like we did question 3. Okay, you can finish up that and check your answers. Question 5, we got this from Yahoo Finance. We got it from Yahoo Finance. So a quick look at this. Okay, what is the 52-week high? What would be the 52-week high? That would be $71.78. What would be the 52-week low? That would be $53. What would be the highest price? Highest price that it was traded yesterday. That would be $67.24. What was the lowest price that it was traded yesterday? That would be $65.86. Dollar General stock, DG, Dollar General. So this is from Yahoo Finance. Just got it. What is the difference between opening price today and yesterday's closing price? So if you look at it, opening price today was what? $67.14. Yesterday's closing price was what? $67.06. So what's the difference? You subtract and it gives you 8 cents. These are some of the websites that are very useful. Investor.gov, it is the government website, tells you about the bonds, mutual funds, and a lot of important information about investments. Savingsbonds.gov tell you about the My ROA, the one that President Obama announced about, and there are nice calculators, in both websites. Good financial calculators, even on my website too. Not only on them. On my website, I have. You go to resources, investment calculators. This is interest and annuities calculator. It has a lot of that, and it's original project. I just taught them Visual Basic, and they use Visual Basic programming to program it. To write apps on it. So this is the annuity, future value of annuity. So like what we did. Let's look at the question 4, right? Question 4 was the payment is $10,000. So I'll come here, $10,000. 10,000, and the rate was 7.5%. 7.5%. Time was 15 years, right? 15 years. 15. Select years. Given these options. Compounded annually. Calculate. So future value, you see that 261,184. That was what we got. Yeah, I'm proud of my students, Visual Basic apps is nice. I have when you want, if you want to see more of them, click here to go back to the previous page. Click on technology, and then click on Visual Basic and click on apps. Savingsbonds.gov, NASDAQ, Computershare, New York Stock Exchange. This one is the stock table I showed you about, an example of the stock table. And then Yahoo Finance gives you a lot about the companies. Thank you for listening so far. It is a lot. Thank you so much for listening. Watch out for other parts. And you have a great evening.